Hello, ladies and gentlemen, boys and girls, bulls and bears, and everybody in between. Lately, YouTube has been killing my videos, citing copyright violations. So today, we're going to keep it basic, and on today's show, we're going to be talking about the US macro environment, where the market expects future growth to come from, stocks I'm buying now, and does valuation matter? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks slid on Thursday as the post-election rally stalled further. Investors assessed remarks from Jerome Powell, who said the central bank were not in a hurry to lower interest rates, and this put a damper on the mood on stocks. The vast majority of the market was lower. The Dow Jones was lower, the S&P 500, as well as the Nasdaq, and the majority of the move actually stemmed after Jerome Powell's speech. We saw a sharp move lower circa midday, and that meant everything from tech to financials to industrials were all headed lower, with the only green sector today here being XLE, which was up 0.43%. XLC, the communication services sector, as well as staples and financials, outperformed relatively speaking to the other parts of the market, but they were still red. We still saw broad-based declines across the board. The S&P 500 sort of in the middle of the pack, down 0.61%, and the worst performing sector was highly cyclical sectors: XLY, the discretionary space, XLI, industrials, as well as healthcare. And that also has to do with a Trump trade. We're seeing, Trump is tough on healthcare, wants cheaper healthcare prices, and that's going to affect the overall earnings picture for healthcare stocks. And it wasn't just large caps. We saw declines across the board: small caps, mid caps, large caps, and really what outperformed was the value side of the market here today. And what really took it on the chin was the growth side, particularly in small caps. But mid cap growth, large cap growth, small cap growth, all sliding in excess of 1% today. And that's a pretty ugly day if you ask me, all things considered. But that wasn't the case globally. We saw very bullish momentum here in the European session. China was very red. However, India was green, Southeast Asia was red, Australia was green, and South America and Canada were green as well. It's just that the US a bit red, but globally we actually saw a very upbeat day. So for those of you that had global exposure, your portfolios probably outperformed relatively speaking. But let's actually talk about the US and why we saw the price action we did today, because it was pretty ugly. This is pretty ugly price action. And the very first thing was actually the House results. Republicans held on to the slim majority in the House of Representatives, giving Donald Trump the trifecta: unified control across Washington, the Senate, the House, and the executive branch. The sweep limits curbs on implementing the incoming president's aggressive economic agenda, which has helped spur the post-election breakneck rally we've seen in stocks. And this is just another piece of the puzzle. It's official: 218 versus 209 in the House. Very interesting. So we'll see what that means for Trump policies looking ahead. We also got Disney's earnings. Disney bucked the market trend today. They were up 6% on the day, at one point being nearly 10% higher, seeing the rally fade like the rest of the market from about midday. Nonetheless, a very bullish day regardless, and that's because Disney dropped their fourth quarter earnings. Earnings per share and revenue topped Wall Street's estimates, and its direct-to-consumer business also finally swung into profit. They issued strong guidance for the next 2 years as well, and what really drove this earnings was the DTC business, which includes Disney Plus, Hulu, and ESPN. It posted operating income of $321 million for the 3 months ending September 28. That compares to the same quarter last year, where they actually had a $387 million loss. So Disney Plus, Hulu, and ESPN finally profitable, and now this is really going to help margins expand for Disney. It's exactly what you want to see when a business is implementing a new business, right? You want to see a turn to profitability, and and that is just margin accretive for shareholders. And I think this is really going to help Disney stock go to the 120, 125 area into their next quarterly earnings. What also really helped the market today was Apple. Apple was up 1% on the day, but at its highs nearly 2%. And that's because Apple is reportedly gearing up to launch a wall-mounted smart home tablet in 2025, adding another piece to its ever-expanding product ecosystem. And this is according to Bloomberg. This device will serve as a home hub featuring a 6-inch touchscreen and the ability to control smart home appliances via voice, powered by Apple Intelligence, and possibly a new system called App Intense. We'll see what that looks like, and that's why Apple actually again bucked the market trend and was up today. However, we did get some sour news on the economic front. Wholesale inflation, which is PPI, came in hotter than expected, and this prompted fresh questions on the Fed's next path. Now, it does say here that the actual and consensus came in at 0.2, but those are rounding figures. It came in a little bit firmer than expected. However, initial jobless claims, which is a high quality, high frequency data set for the labor market, still continues to trend downward. That's exactly what you want to see. So mixed data, but the market really looking at PPI as well as Jerome Powell's speech. Now, Jerome Powell came out, spoke, and this is what really dampened the mood today. This drove the markets lower, and Jerome Powell came out and said the central bank does not need to be in a hurry to lower interest rates due to the economy's strength, and what the Fed would be watching carefully to make sure certain inflation measures stay within their acceptable range. So now the Fed's looking at inflation and how it pertains to growth. Powell said the economy is not sending any signals that we need to be in a hurry to lower rates. The strength that we are currently seeing in the economy gives us the ability to approach the decision carefully. And pretty much the focus is now on how the Fed and Jerome Powell see inflation developing as investors gauge the odds of rates going back to staying higher for longer. To that point, Powell stressed the US economic strength, saying that the Fed would be watching carefully to make sure inflation measures are within their range. So long story short, we're looking at inflation. We think growth is strong. We might not cut as aggressively as once thought. I think we all kind of knew this, but just hearing it from the horse's mouth meant it was real, and the market sold off as a result. And we really did see this in the shorter term trends, guys. The 5-day moving average looks horrendous right now. However, everything from the 20-day all the way to the 200-day moving average still looks very, very solid, particularly this right here, the 100-day moving average above 60%. Guys, yes, the markets did pull back today, and we have seen a pullback from the highs after the election rally, but things are still looking very, very good for the longer term trends, medium term trends, and to a degree, the shorter term trends as well. However, 5-day is sending us a bit of a warning, and so we do have to look at that accordingly to assess what happens. But until we actually see a turn in the 20-day moving average as well as a 50-day, I wouldn't really be concerned on the longer term trend being affected. This should just be a buyable dip opportunity for you to get long into the end of the year, riding the continued strong momentum we're seeing in the market. And looking at the charts, look at equities, just total red across the board. The S&P 500, the NASDAQ 100 down 0.6%, the IWM down another 1.35%. Things not looking that great here in the after hours for the Qs, the S&P 500, the IWM. Mid caps fell, small caps fell. It was a brutal day here in the market, but we saw mixed action in yields. The 2-year yield gained, longer term yields were kind of flattened down, especially on the longer end, the 30-year yield, and the dollar just keeps on rising, which is absolutely insane when you think about it. And that affected commodities. I feel like I say the exact same thing over and over again, but that's what's been happening. Yields kind of rising, the dollar rising, commodities falling, except for silver. Silver up 0.59%, crude as well. That's why energy stocks were sort of upbeat here today. But all in all, a very ugly day. You didn't want to be anywhere. There were no safe havens apart from the dollar. And again, what we are seeing is just a bit of churn, just a bit of profit taking, and just a bit of the market reacting to various things going on. The PPI data, the inflation data, waiting on retail sales, reacting to what Jerome Powell has said. Now, I don't think what Jerome Powell said was bad. Like I showed you in yesterday's video, and you guys should go and check it out, that if the Fed actually takes longer to cut rates, slower cutting cycles are actually very, very good for stocks. And that's exactly what we're seeing. We're probably going to be in a period of stronger economic growth and a slower cutting cycle. And that means this cutting cycle is going to go on for a longer period of time, and that's going to support the bull market for a longer period of time. And that's exactly what we want. We want this rally to go as long and as high as possible, and slower rate cutting cycles sort of ensure that to a degree. But looking at the S&P 500, guys, what we actually saw today was again a move down here in the positive gamma, closer to the gamma flip zone. The lines have not changed, but we are still in positive gamma. So, we just want to look for opportunities to buy dips that is near the gamma flip. So maybe we get one more day of selling. We are officially in a daily downtrend, as you can see in this right here, but things still looking technically strong. I mean, we haven't really fallen out of the sky, and until we actually break the gamma flip and actually fall below the 58.75 area, the S&P 500 looks very, very strong. It's just that the market, it's taking its time to pull back. The same is true with the Nasdaq 100. This looks very, very good. We're not even below the 20,700 level, which was the previous all-time high we made in that June-July area. The market again just taking its time to pull back, and that's really, really constructive because it means there are bulls and bears on both sides of the trade. It's just that the bears are winning ever so slightly. But in a market rally that we've had for the better part of the last year, this is actually very, very constructive price action. Even when we dive into the RTY, now it is negative gamma, and that means our target is the 2300 area. And from a technician standpoint, if you just use support and resistance lines, look, this was the breakout zone, and as long as we hold this area right and then continue the move upward from there, that would just be trend continuation, and that would be very, very strong. So 2300 is both the put support right now. If it moves, it moves, but it's also a key level of support because we use it as resistance right here, resistance right here. When we broke that resistance then turns into support, and if that support does hold and we do move higher, break the 52-week highs we made right here, break the all-time highs we made in early 2021, then it's off to the races. Nonetheless, I think equities look very, very constructive in my opinion. We're just sort of seeing a bit of profit taking in this middle part of November, and guys, seasonally, what we see from about November 10th to November 22nd is just digestion. We just see digestion of gains. That's exactly what we're seeing now. When you look at a seasonal chart, digestion sort of just looks like sideways price momentum, but in the real markets, digestion looks like that, okay? The seasonal charts are sort of compressing a whole bunch of data into a single line. It's a bit more noisy when you look at it on a day-to-day basis, and that's why we're seeing the market price action we're seeing. But I think the markets still look very constructive for us to go higher into the end of the year, into the first quarter of 2025. And I think what we really should be watching, guys, is the RTY, the IWM, right, as well as the RSP. I think the equal weight is something that we really need to be watching because the broadening out is a big story right now. And you know what? If we actually find support right here in the RSP and continue higher, that would be constructive. But I think as long as we stay above the 176 area, we're looking very, very good in the RSP. So guys, this is it. In the RTY, the Russell 2000, you want to buy the 2300 area if we get there. But, I would start dollar cost averaging from here because this chart looks very, very constructive. Look at the yearly chart in the IWM. That is just higher highs, higher lows, new 52-week highs, extremely close to all-time highs. In the NDX, the Nasdaq 100, that's the 20,560 area. The S&P 500, that's the 5905 area. So guys, if we do pull back further, those are the levels of support you want to buy because we will be going higher into the end of the year. I do think we're going to finish the year above 6,000 for the S&P 500, and the path of least resistance is still higher. All of the comments Powell just made today is actually longer term bullish if you really, really think about it. Slower cutting cycles are very good for market momentum. It's just that the market tends to overreact. So all in all, guys, this pullback we're seeing, take it as an opportunity to get long because we will go higher into the end of the year. We just have to get over this November churn period, which sort of ends in the back half of November. So about, I would say, 7 more days of sideways price momentum to downward price momentum, and then we could go higher from here. This is a AA sentiment survey, and what direction do AA members feel the stock market will be in the next 6 months? 49.8% said bullish, in other words, higher. And it's very interesting to see because in the last 3 weeks, we've seen 29 to 30% being sort of the zone of neutrality. However, after the certainty from the election last week, those that were neutral jumped into the bullish category, 28.3% only in the bearish camp. The long-term averages across the board is about 33 to 36%. But what we're really seeing is generally a lack of bears and very euphoric bullish sentiment. And this also comes on the back of what is a seasonally strong month. November tends to be very strong. However, we are in this middle part of November right now, which is a digestion phase. So we get the rally, then we digest, then we get the next part of the rally. But healthy market momentum requires digestion, requires pullbacks. But as long as we make a higher low, the trend is still up and we are yet to see what is to come. But as it is right now, guys, if we actually see sideways to downward momentum towards the 20th, 21st, and 22nd of November, that is okay. As long as we make a higher low, the path normally is higher, at least according to history, with an average return of 1.8% for the full month of November, data going back since 1950. But apart from seasonality, what will drive US equity returns over the next 30 days? And according to the market, central bank policy is the number one thing on people's mind. They believe that will drive market momentum, as well as the US macro environment. In third place, we had shareholder returns, equity fundamentals, and government fiscal policy. And then the last three, the political environment, the global macro environment, and valuation is actually going to weigh on the market overall. And I think particularly the political environment, things can get very divisive between now and the inauguration. But what I kind of disagree with is actually valuation. I think that the environment we're in, valuation doesn't really matter in the short term. And I have evidence to back this up. According to Goldman Sachs, stocks and credit outperform when valuations are stretched. In fact, what we normally see in 6 months when PE ratios are in the 95th percentile, where they are right now, we see 18% average returns for the 6 months following. The average return is actually 13%. We actually see credit have stark outperformance. And what is the worst performer? Actually gold, commodities. Because why would you just hold gold, which is a currency hedge of sorts, when you can hold equities, which has a growth component, a dividend component, and a buyback component? All those drive returns, and that is why. And even though valuations can seem scary, historically buying can be a good idea, especially in the short term, looking at 6 months and beyond. But let's actually go a bit longer. Let's dig deeper beyond just 6 months and look at the last 5 years and what has actually driven S&P 500 returns. And we can see across the globe since 2019, the S&P 500 is up 100%, so nearly a double. And in this time period, we have had a global pandemic, 2 bear markets, 2 elections, inflation at 40-year highs, and the Fed going from 3 to 0 to 5. Breaking it all down, guys, what we saw is that an increase in multiples accounted for 26% of the gain, earnings growth accounted for 59% of the gain, dividends accounted for 15%, and that racks up the total 100% for earnings growth. If we then look at it in terms of sales growth, margins, and multiple growth, 43% was sales growth, 16% was multiple growth, 15% was dividends, and 26% was multiple growth. So all in all, even though stocks have rallied a lot of it has been backed up by fundamentals, by our earnings, sales, margins, as well as dividends. So the rally we're seeing, yes, valuations are stretched. I do get that, but there's a lot of fundamental backing, and we are going into an environment with easier monetary policy, and seasonally, things are looking very, very good for stocks. So you do want to continue holding in this environment because it's not just the fundamentals that's good. The macro looking very sound. We're looking at GDP for the fourth quarter tracking at about 2.5%. CPI, the inflation rate, continues to disinflate. We see continued downward movement in the overall CPI. This is the core inflation rate. And even though we have seen an uptick here, the market largely expected this. This largely has to do with the comps coming into the end of the year. The employment rate is at 4.1%, very, very steady. This is pretty much full employment. And yes, even though we have seen a stark move up here in the 10-year break-even inflation swaps, this to me looks more like a re-rating of growth than it is an actual inflation scare. And that's why we've actually seen equities rally, commodities pull back. It's largely just a re-rating of growth, and that does come with slightly higher inflation expectations. Looking at earnings for the rest of the week, the big one tomorrow is going to be Baba. That's really it. There's There's nothing else worth noting, but Baba's going to be on everyone's lips. And then in terms of data, we just get US retail sales. We get to see how the consumer is doing. Guys, the forecast right there is 0.3%. So I think if we beat that, great. If we miss, we'll see what happens. But all in all, guys, we want to look at Baba's earnings as well as retail sales. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell as well as the like button, and leave a comment for the algorithm. Cheers.